The FTX event is something that, frankly, there's no reason for the crypto industry to repeat again. And I think there's a very healthy realization of that in the industry as a whole, because today solutions exist for us to prevent something like FTX from happening. And that's actually a really strong realization for the industry, and an important one to continue to capitalize on. Right? There's two very straightforward trajectories, right, that the industry needs to follow to prevent something like FTX from happening in the future. One, obviously, is self-custody. Right? We need to continue to educate the retail audience. We need to continue to invest in self-custody based solutions. And in the event that we increase the adoption of self-custody for crypto overall, and even if somebody like FTX goes out of business for whatever reason, and this happens, right, in the world today, and in their traditional finance, companies go out of business. They make bad decisions. But their users and their consumers are protected. Right, and we can do that in crypto with self-custody. Now, the second piece is that, this is not to say that we will not see any organizations in crypto providing services, financial services and other types of services, where there'll be institutions managing other people's assets, right? There will still be a considerable amount of demand for that. I don't envision that ever really going away. So the second dimension that we really need to capitalize on is governance. Very simply, right? So if an organization is in the business of managing other people's money, which is an acceptable business, there needs to be a certain level of standards globally available to prevent something like FTX from happening again, right? And frankly, these are important standards. These are standards that are well known and established in the financial industry today. They're applicable to crypto. They're global in nature, and the tools exist. Right? So the tools for transparency, for proof of reserves, for validating that you're maintaining your client's assets in the right ways, right? Governance, making sure that a single bad actor that makes a bad decision doesn't get to actually execute on that bad decision, right? And there's checks and balances in place at the corporate governance level, as well as security, just pure fundamental security to make sure that a bad actor cannot take advantage of a gap in security, a gap in governance, and maliciously act in the interest of themselves versus in the interest of the clients. And tools today exist to be able to solve for these problems. Companies and organizations and the industry as a whole needs to invest in those tools. They need to be adopted. Communities need to be educated. And companies simply need to invest, and then we'll be in the clear. And we see the industry developing as a whole, right? So we need to raise the bar collectively and incrementally to make self-custody as easy and usable as possible while preserving the security and self-sovereignty. Right, so as you can imagine, these are two sometimes contradictory priorities. Right, security isn't free. Right, there needs to be an investment that's being made there. Freedom isn't free; it requires a certain investment. We have several tools coming out next year to make it very streamlined and very simple to leverage your device to interact with DeFi, DApps, and a wide range of different cases. So we're continuing to invest in these tools to make it much easier for a wider set of users to easily interact with crypto, right? Security is paramount. We have to preserve security. We have to preserve self-custody. And I think to your point for the previous question is now the audience really understands that there is a trade-off, right? The ease of use that you get by allowing an exchange or another entity to manage your assets for you comes at a cost. There is a risk involved. And it was very clearly seen what that risk is with FTX. So I think that awareness is very healthy, and the retail audience has a choice to make in that regard. I think the hardware wallet space specifically should not come under any regulatory scrutiny, right? The regulators are really there for consumer protection. Right, that's their primary mandate, is to make sure that the taxpayers of their jurisdiction are properly treated by organizations, right, and are not being taken advantage of, and their assets and their livelihoods are protected from events like FTX and other high-risk type of investments. So there, I think regulation could be extremely healthy. The challenges, of course, is that regulation is not always perfect, always comes with a set of challenges, and usually is created at a point in time. And what we see in crypto is that our evolution and innovation cycle is so fast, right, that any type of regulation that's introduced to a specific event at any given point in time really becomes not as impactful next year and the year after that. And really, that's the challenge that the regulators have to wrestle with, and that we as an industry have to educate them to help them manage that rapid pace of change that we see in the crypto industry today. Another aspect that's going to be critical to properly manage is that crypto is global, and regulation by definition is regional. And that is where we're going to see a lot of challenges and constraints as to how do you regulate a global distributed ecosystem based on localized governance frameworks. So we're actually very hopeful that crypto as a whole will continue to perpetuate globalization and global standards for regulating the financial ecosystem and inclusion in the overall financial services globally. So I come from traditional markets. I was with NASDAQ for 12 years in the capital markets ecosystem. And a lot of that ecosystem exists for the purpose of trading, for speculatory aspects, but also making investment opportunities available to individuals and to the world at large, which is a great mandate. I think the important thing to understand with these recent sequence of events with FTX and frankly others, right? So, crypto took a bit of a hit earlier in the year. I think part of that was the causal effect of other events like FTX and some of the hacks that we've seen, right? Once you introduce stress into a system, you really see where the cracks are. And this is what we're seeing today. But I think this was a very important and pivotal turning point in the history of crypto overall, because what I envision now and what Ledger is extremely well positioned to help support and drive forward is that the crypto ecosystem is going to start to pivot from speculation to value creation, which is going to be super exciting and very interesting for us because fundamentally Ledger provides services to retail users around crypto use cases. Managing your crypto assets, interacting with DeFi, making the right investments, contributing to proof of stake and staking capabilities, interacting with DeFi, but also working with NFTs and the digitization of value overall, building communities and seeing how that entire ecosystem evolves over time. We're going to see a lot of major brands and organizations start to build in the ecosystem versus just coming in to trade and to speculate. And that is going to be a critical shift in how the ecosystem continues to grow, and is going to bring in a significant influx of scale and scalability, right? If you think about it, trading is one aspect, but when you're talking to a Fortune 100 company that wants to reach its multi-million or hundreds of millions user base, right, with NFTs, with digital value, with proof of attendance, with any type of social community building engagement, right, then you're talking about completely different levels of scale than what the industry has seen today. And I think in that context, it's very important to understand we have been very focused on banking and the financial ecosystem entering the crypto space. What we tend to forget as an industry is that banks have customers. Banks do not exist for the sole purpose of trading and speculating on assets. Banks exist to service large corporate institutions that have global presences and helping them manage their money and their assets to facilitate their operating models, to serve users like you and I. And in that context, when crypto becomes a significant enough tool to be leveraged by these global organizations for real use cases towards real retail audiences like you and I, then the banks will take notice because they will need to provide services to their clients versus just coming in and speculating. I think it's a very important time to really take a look back at the year that crypto had as an industry, right? We've seen significant growth in the beginning of the year. We hit all-time highs, and things were looking really, really rosy in the context of the crypto ecosystem. Then there were some stumbling blocks, and this is perfectly normal in the evolution life cycle. We've had some critical events with the closure of FTX, and I think there's a lot of lessons learned that the industry needs to take away from this. So the lessons are simple, right? Self-custody is here to stay. Autonomy of users is critical. Not your keys, not your coin. And also that for scalability, in the crypto ecosystem, the tools today exist for companies and large organizations to do the right thing and properly manage their users and the user's experience in the crypto ecosystem. The tools are there. The companies need to make a conscious decision to invest in transparency, to invest in governance, and to invest in security. And then the crypto ecosystem can continue to scale at the tremendous rate that we have seen so far.